Restricted Stock Unit Comprehensive Guide. Welcome everyone. My name is Tan and I'm an independent certified financial planner practitioner at Tan Wealth Management. Today's educational video is on Restricted Stock Unit. What are Restricted Stock Units? Restricted Stock Units are equity compensation. RSUs are an unfunded promise from the company to you stating the company will give you X number of shares if you satisfy their vesting condition. When your employer gives you a restricted stock unit, you don't actually receive the employer's stock. The word units mean you exchange units for the actual employer stock. The word restricted means there are requirements you have to meet. It could be based on the length of employment or performance goals. One restricted stock unit represents one share of the actual employer's stock. With RSU, no shares are issued to you at grant. The shares are delivered to you at vesting, and that is taxable supplemental income to you. RSUs are always worth something unless the stock price drops to zero. For example, the company grants you 1,000 RSU. At vesting, the stock price is $500 per share. 1,000 shares times $500 equal $500,000. Grant date. There is no taxable event on the grant date. The employer grants you the award to receive restricted stock unit, which means the employer promises you X number of shares of the employer stocks in your brokerage account if you meet certain requirements, such as staying employed with the company for 3 years. It is a future promise from the employer to the employee. No tax liability because if you did not meet the requirements, could be based on performance goals and or stay employed to a certain date, you will receive nothing. The restricted stock units have a substantial risk of forfeiture. What is a substantial risk of forfeiture? Property is subject to a substantial risk of forfeiture if there is a substantial possibility that the property will not be forfeit if the condition does not occur. It means there is a possibility you will get nothing. For restricted stock unit, the stock price on the grant date does not matter. The stock price matters at vesting because you have full control of the shares, which means you can sell the shares and get cash for it. Vesting period. The period between the grant date and the vesting date is considered the vesting period, or you can call it the waiting period. Restricted stock unit and restricted stocks are different. During the vesting period, restricted stock units have no shareholder voting rights and normally do not receive dividends. With restricted stock, during the restricted period / vesting period, dividends are paid and you have voting rights. If the company pays dividends on the outstanding shares, dividends may be deferred for additional shares or cash on the vesting date. It is in the plan agreement if the company pays dividends equivalent. You can also check your human resource department. Restricted stock unit is not restricted stock. Vesting schedule. Cliff vesting. You receive all the shares at once, such as you receive all the shares in 3 years. Graded vesting. You receive shares at regular intervals until you receive all the shares. Hybrid of cliff and graded vesting. A combination of some shares upfront, then shares at regular intervals until you receive all the shares. Example of cliff vesting. In 2020, your employer grants you 1,000 restricted stock unit or restricted stocks, and it will vest in 3 years, which is 2023. 0 share vest in 2021, 0 share vest in 2022, 1,000 share vest in 2023. Example of graded vesting. In 2020, your employer grants you 1,000 restricted stock units or restricted stocks, and it will vest 25% annually. 250 shares vest in 2021, 250 shares vest in 2022, 250 shares vest in 2023, 250 shares vest in 2024. Example of cliff and graded vesting. In 2020, your employer grants you 1,000 restricted stock unit or restricted stock, and it will vest in a year at 25% in year 1, 25% in year 2, and 50% in year 3. 250 shares will vest in 2021, 250 shares will vest in 2022, 500 shares will vest in 2023. How to estimate your restricted stock units and restricted stock value. For public companies, you can multiply your number of shares times the current stock price. For private companies, you can multiply your number of shares times the latest round of funding or available price. I normally don't like to incorporate the values of the restricted stock units and restricted stocks in my clients' financial plans because the restricted stock unit and restricted stock might not vest. Therefore, the client will get nothing. If they like, I can always show them the difference between incorporating the unvested shares and without the unvested shares in their financial plan. Internal Revenue Code Section 83B election. What is Internal Revenue Code Section 83B election? A 83B election is a provision that allows you to pay taxes on the fair market value of the stock based on the grant date instead of the vesting date. You cannot make an 83B election on restricted stock units. You can make a 83B elections on restricted stock. For restricted stock, when you make a 83B election within 30 days from the date of grant, you can recognize ordinary income on the value of the stock based on the grant date instead of the vesting date. Restricted stock can be taxed on the value of the shares at the grant date and at the vesting date because they are considered property within the Internal Revenue Code Section 83. You do not have this option with restricted stock unit because they are not considered property within the Internal Revenue Code Section 83. This is directly from the IRS website. Restricted stock units are not considered property for purposes of IRC 83 since no actual property has been transferred and therefore a IRC Section 83B election cannot be made with respect to the grant of the restricted stock unit. Dividend. How do I get taxed on the dividends from restricted stock units? For restricted stock units, during the vesting period, if the company pays dividends or dividends equivalent, the dividends will be reported as wages on your W-2. According to the IRS website, if an employee or independent contractor receives dividends or other income from substantial non-vested restricted stock, the amount are considered additional compensation to the individual and must be included in income, are subject to employment taxes and may be deductible by the corporation. Once the restricted stocks award vests, the dividends are treated as dividends income rather than compensation. Vesting date. This is a taxable event. Shares or cash equivalents are deposited in your account on the vesting date. When the restricted stock unit and or restricted stock vests, the employer stocks is deposited in your account or the company can deposit cash in your account that is equivalent to the share fair market value. You can look in your plan agreement or ask your human resource department for more details on your specific plan. Your taxable income is based on the fair market value of the shares at vesting minus any cost you pay to acquire the shares and is subject to supplemental wage withholding, which includes Social Security tax up to the yearly maximum, which is $137,700 for 2020 tax year, Medicare tax, federal tax, state tax, and local tax if any. Here is the formula. Number of vested shares times fair market value of the stocks at the vesting date equal supplemental wage reported on W-2. The tax withholding may be in the form of employee shares or cash to cover the taxes. Restricted stocks unit and restricted stocks are taxed as supplemental wage as soon as they become vested. If you keep the shares, you are entitled to voting rights and dividends if any. The employee shares are yours and you can do whatever you want. as long as there are no other restrictions. You can sell some or all of the employee shares. Normally, vesting stops when you are terminated from your jobs and accelerate when you are deceased, become disabled, or retire. You want to truly understand your plan agreement. You should read your plan document and ask your human resource department about the provisions. What happens if you become disabled, retire, die, or get terminated during the vesting period? You want to know the provisions to help you with your financial planning. I have clients that ask me, 10, I have restricted stock units or restricted stocks that vest annually and I don't know why I keep getting taxed on it even though I did not sell it. I tell them, because the restricted stock units and restricted stocks are taxed on the vesting date. There will be another taxable event when they sell their employer stock. From Cornell Law School, wage income recognized on the lapse of a restrictions on restricted property transfer from an employer to an employee is considered supplemental wage payment. Internal Revenue Code Section 409A. What is Section 409A? Section 409A was added to the Internal Revenue Code by Sections 885 of the America Job Creations Act of 2014. Section 409A generally provides that unless certain requirements are met, amount deferred under a non-qualified deferred compensation plan for all taxable years are currently includable in gross income to the extent not subject to a substantial risk of forfeiture and not previously included in gross income. That is saying when the restricted stock unit and restricted stock vest, the employer stock is yours and you do not have the risk of losing the employer stock. Therefore, the fair market value you receive will be included as income to you. For example, Luna works at Apple. She looks at her My Stock plan and 300 shares are expected to vest in 2020. In 2020, Apple shares is at $304 per share. 300 shares times $340 per share equal $102,000 reported as supplemental wage to Luna. The $102,000 from the vested stock is in addition to the other benefits she received from Apple, such as her salary, 401k matching contribution, health saving account matching contribution, employee assistance program, etc. Tax withholding method starting with the highest risk due to a concentrated stock position. Cash exercise or cash transfer. You give your employer the money to pay for the tax withholding. All of the vested shares will be deposited to your brokerage account. Net share settlement, share surrender, share withholding, net share issuance, or net settlement. Your employer will keep shares equal to the tax withholding, then the remaining shares will be deposited to your brokerage account. Sell to cover or selling shares. The plan will sell enough shares to cover the tax withholding, then the remaining shares will be deposited to your brokerage account. Same day sale. The plan will sell all of the shares on the vesting date. After subtracting the tax withholding, the net cash will be deposited to your brokerage account. How will Luna cover her taxes? Here's the background. Apple promised Luna 300 Apple shares in 2020. In 2020, Apple share is at $304 per share. 300 shares times $340 per share equal $102,000, reported as supplemental wage to Luna. Let's assume Apple will withhold 22% for taxes, which is $102,000 times 22% equal $22,440 or 66 shares. $22,440 divided by $340. An example of cash exercise. Luna will pay $22,440 to Apple for the tax withholding, and 300 shares will be deposited to Luna's E-Trade account. An example of net share settlement. The plan will withhold 66 shares for tax withholding. 234 Apple shares are transferred to Luna's E-Trade account. An example of sell to cover. The plan will do the calculation and sell enough shares to cover the 22% tax withholding. 22% of 300 shares is 66 shares. The plan will sell 66 shares for the tax withholding. 234 Apple shares are transferred to Luna's E-Trade account. An example of same-day sale. The plan will sell 300 Apple shares, which is valued at $102,000. The plan will withhold 22% for tax withholding, which is $22,440. $79,560 in cash will be transferred to Luna E-Trade account. Stock swap. If the plan allows, you can use your existing employer stock to exercise a stock option from your employer. For example, you own your employer stock through vested restricted stock units and/or restricted stock. You also have incentive stock options, ISO, in the money you want to exercise. The plan will do the calculation to let you know how much cash you will need to pay to exercise the ISO or swap X number of shares of the employer stock to exercise the ISO. You can pay in cash or employer stock. It's up to you. Why do a stock swap? 1. You don't have the money to exercise the stock option. 2. You want to minimize the number of shares of the employer stock. Why not do a stock swap? 1. Keeping track of the cost basis, gains, bargain element for calculating the term minimum tax, and the dates of acquired shares from different batches and types of shares can be complicated. 2. The tax implications of stock swaps are taxed differently depending on what you are swapping the existing employer stocks for. Are you swapping the existing employer stocks with non-qualified stock options or instead stock options? Estimated tax due. You can estimate how much the tax due is by multiplying the number of shares times the market value of the stock at the vesting date, then multiplying it by the estimated tax rate to get the estimated tax due. Number of shares times market value of the stock at the vesting date equal supplemental wage. Supplemental wage times your estimated tax rate equal estimated tax due. If you want to know what the shares are for tax withholding, just divide the tax due by the market value of the stock at the vesting date equal to the amount of the shares needed for tax withholding. Continuing from our example of Luna, 300 shares times $304 per share equal $102,000 is the supplemental wage to Luna. $102,000 times 22% assumed Luna tax rate equal $22,440 estimated tax due. $22,440 divided by $340 equal 66 shares for the tax withholding. Please be advised that when Luna does her taxes in 2021 for the 2020 tax year, she could receive some money back because she overpaid in taxes, or she could pay more in taxes because she did not pay enough taxes. Sell date. This is a taxable event. Any price change in the employer stock price after the vesting date is treated as capital gain or loss. Long-term or short-term depends on the holding period, which is the difference between the share acquired date to the share sold date. Short-term is considered 1 year or less, which is 365 days or less. Short-term holding period is taxed at ordinary income tax rates. Long-term is considered more than 1 year, which is more than 365 days. Long-term holding period is taxed at long-term capital gains tax rates. What should I do after my restricted stock unit and/or restricted stock vests? If you hold your restricted stock unit and/or restricted stock after it vests, it's like you just bought your employer stock at the current price. If you receive a bonus, will you take that money and buy your employer stock in your brokerage account? Why do employees want to hold onto their employer stock after it vests? The employee do not want to miss out on the employer stock appreciation. If they sell the employer stocks and then the employer stock keeps going up, they will regret selling the employer stock. If you are going to keep your employer stock, maybe you should have no more than 10% of your overall investable asset in your employer stock. For example, if you have $1 million of investable asset, no more than 10%, which is $100,000, should be in the employer stock. For a conservative risk tolerance investor, it is good to sell the vested shares. For aggressive risk tolerance investor, they can sell half of the vested shares and keep the remaining half so they don't feel like they are missing out if the employer stock price increases in the future. Or keep all the vested shares and build a portfolio around the employer stock. These are just examples and you can do whatever you like because it's your money and you work hard for it. If you keep the employer stock, you should know you are exposed to systematic risk and unsystematic risk. I created an educational video on why you should be cautious when investing in individual stocks so investors can learn more about holding individual stocks. If you sell the employer stocks, you should understand your tax liability. If you receive the shares at $340 per share and you sold it for more than $340 per share, you have a capital gain. If you sold the shares for less than $340, you have a capital loss. If you purchased the shares on June 15, 2020, and you sold it on June 15, 2021, do you have a short-term or long-term holding period? Short-term, because it is exactly 1 year. I've seen a lot of financial advisors and investors make this mistake all the time. Here is a direct quote from the IRS website. If you hold the asset for more than 1 year, your capital gain or loss is long-term. If you hold the asset 1 year or less, your capital gain or loss is short-term. To figure the holding period, begin counting on the day after you receive the property and include the day you dispose of the property. Continuing from the example of Luna working at Apple. Grant date. This is not a taxable event. Apple grant 300 restricted stock unit or restricted stock to Luna and it vests on June 1st, 2020. Vesting date. This is a taxable event. 300 shares times $340 per share equal $102,000, which is supplemental wage to Luna. She acquired the shares on June 1st, 2020. Sell date. Scenario 1. This is a taxable event. Luna sold all of her shares on July 1st, 2020 at $400 per share. $400 purchase price per share minus $340 cost basis equals $60 gain. $60 gains times 300 shares equal $18,000 gain. The holding period is short term and it will be taxed at ordinary income tax rates. $18,000 gain times 37% assumed tax rate equals $6,660 tax due. Scenario 2. This is a taxable event. Luna sold all of her shares on August 1st, 2021 at $400 per share. $400 purchase price per share minus $340 cost basis equals $60 gain. $60 gains times 300 shares equal $18,000 gain. The holding period is long-term and it will be taxed at long-term capital gains tax rates. $18,000 gains times 20% assumed tax rate equal $3,600 tax due. The difference in tax between short-term of $6,660 and long-term of $3,600 is $3,060. I choose 37% tax rate for short-term holding period and 20% tax rate for long-term holding period because I just picked the highest tax rate for ordinary income tax rate and long-term capital gain tax rate for simplicity. The long-term capital gain tax rates are lower than ordinary income tax rates, but it could change in the future. Avoid insider trading with a Rule 10b-51 trading plan. If you are executive of a public companies and have access to material non-public information, you want to have a plan on how you will sell your employer stock after it vests so you are not accused of insider trading. One solution is to set up a Rule 10b5-1 trading plan, which is pre-arranged trading contract you file with the SEC to let them know how you will sell your employer stock when the condition you set is met, such as 25% of my holding period on the last trading day of the year. You set the condition however you want as long as it is clear to the SEC on how you are doing it. You want to work with a financial planner to determine when you want to sell your employer stock. Then talk to your custodian firm to set up a Rule 10b5-1 trading plan. For high-level executive, your financial planner will work with your attorney and accounting to make sure everyone is working together to give you the proper recommendations, such as, do they qualify as an executive under the Section 16B of the Securities Exchange Act of 1934? If so, there are rules they have to follow. What you should know about restricted stock units and restricted stock plans. You should really understand your plan. How many shares you will receive by when and what are the restrictions? What are you going to do once the shares are vested? How are you going to pay for the tax withholding? Are you going to tell your employer to withhold the shares or give the employer money for the tax withholding? Questions to ask your employer so you can truly understand your restricted stock unit and restricted stock plans. What is my vesting period? Is it based on how long I have to be with the company or based on my performance or both? When and how can I be fully vested? What happens if there are major company events like a merger or acquisition? What happens if I were to leave or lose my job, become disabled, die, or retire? What are the tax withholdings? Can I increase or decrease the tax withholding? Do I have restricted stock unit and or restricted stock? When the shares are vested, how can I have access to it? If the company pays dividends, do I get it and how does it work? Can I designate a beneficiary? Am I expected to receive more restricted stock unit or restricted stock in the future? If so, how many shares are dollar value? How can I get more restricted stock units or restricted stock? Your employer may tell you to read the plan agreement and you want to tell them that you read the plan agreement and you want to confirm with them. If your employer cannot answer the question, ask them who can. When you sell the stock, ask a qualified tax preparer if you need to file Form 8949 and Schedule D on your tax return. Chances are you do have to file it. Some restricted stock unit and restricted stock plans let you defer the delivery of the shares so you can defer earning income tax. You cannot defer the taxes if the shares are delivered to you. Choices you need to decide to optimize your restricted stock units. 1. How are you going to pay for the tax withholding at the vesting date? 2. Are you going to keep the employer stock after it vests? 3. When are you going to sell it? 4. What are you planning to do with the money after you sell the employer stock? Tracking your restricted stock unit and restricted stock is key. You need to track each restricted stock unit and restricted stock lot. How many shares will you receive? When? And what is the estimated dollar amount? What is the total supplemental wage to you and what are the tax implications? When will each restricted stock units and restricted stock lot be considered long-term for the holding period? What is the total gain or loss once you convert the restricted stock units and restricted stocks into cash? Frequently asked questions on restricted stock units and restricted stock. How can I maximize my restricted stock unit and or restricted stock? If you want to maximize your restricted stock units and or restricted stock, you need to have a plan in advance with different alternatives, then pick the best alternative. Here are some questions to assist you in making your decision. Do I truly understand how my restricted stock units and or restricted stock work? What are the provisions and restrictions on my restricted stock units and restricted stock? Once my restricted stock units and or restricted stocks are vested, are there any restrictions or provision? How am I going to pay for the tax withholding? What am I going to do after my restricted stock units and or restricted stock vest? How will my restricted stock units and or restricted stocks incorporate with my financial plan? What are the top 3 things to love about restricted stock unit and restricted stock? Receiving restricted stock units and restricted stocks make you happy because you receive something from your employer. You feel more valued and appreciated. You want to work harder to get more. Vested restricted stock unit and restricted stock increase your net worth. Restricted stock unit and restricted stocks are simple to deal with because you have limited amount of planning you can do compared to other complex stock options, such as incentive stock options. What are my restricted stock units and or restricted stock cost basis, and what happens to the shares my company withhold for taxes? Let me explain this question by giving you a scenario. You receive 4,000 shares at vesting. The company withholds 22%, which is 880 shares for tax withholding. The company may exchange the 880 shares with internal funds, the company money. First taxable event. Your cost basis, which is taxed at earned income tax rates, is based on the 4,000 shares multiplied by the employer stock price at vesting. Second taxable event. Now you only have 3,120 shares in your brokerage account. Any gains or losses are based on the 3,120 shares. You do not have 4,000 shares because the 880 shares are for tax withholding. It's like you earn $100,000 a year and your employer withheld $22,000 for taxes. You only have $78,000 in your bank account. If your employer withhold too much tax, you will get a refund when you file your tax return. If the company did not withhold enough tax, you will have to pay for the tax when you file your tax return. My restricted stock units and or restricted stock vest. I sold shares of my employer stock at a loss. How am I taxed? Ordinary income tax rates on the fair market value at vesting. You have a capital loss on the difference between the stock price at the vesting date and the stock price at the sale date. The capital loss can offset capital gain if you have any. Any remaining loss can reduce up to $3,000 of your earned income. Any remaining loss will be carried into the future until all the loss is gone. What happens to my restricted stock unit and or restricted stocks when my company stock split? Normally, companies like to split their stocks because the stock price is high and they want to split it so it is more affordable for investor. If the company announced a 2-for-1 stock split and you were supposed to get 50 shares, you will now get 100 shares because 50 times 2. If 3-for-1 stock split, 50 shares times 3 equal 150 shares. When should I sell my restricted stock units and or restricted stock? It depends on your goals, financial position, your outlook on the company, etc. You should know there are 2 taxable events with restricted stock units and restricted stock. You get taxed when the shares are vested and when you sell the employer stock. Restricted stock units and restricted stocks are taxed as supplemental wage, which is the same as you get paid for doing your job. Ask yourself, if you get paid for doing your job, will you take that money to buy the employer stock? Answering this question could help you determine if you should sell the shares when it vests or keep it and sell it later. The clients I have worked with have more than one type of equity compensation. In addition to restricted stock units and restricted stocks, they may have employee stock purchase plan, non-qualified stock options, incentive stock options. This makes the decision of when to sell the restricted stock units and restricted stocks more complicated because the timing of when to sell what is key. This is where you want to do tax bracket management. The goal of tax bracket management is to increase after-tax return by reducing taxes in high-income years and increasing taxes in low-income years. There are so many strategies I want to talk about, but you will be sitting here for a couple hours. What are the disadvantages of restricted stocks units and restricted stock? Vested restricted stock units and restricted stocks increase your taxable income. Thus, you could be phased out of certain tax deduction and tax credit. The strategy is to control your tax bracket so you can maximize your wealth, and there are so many strategies you can do, such as: should you make an 83B election for restricted stocks to be taxed at the grant date instead of the vesting date? Branching itemized deduction in 1 year and taking the standard deduction in another year, and many more. What are the common mistakes with restricted stock units and restricted stock? Employees don't understand what they have and how to maximize their benefit. It's like getting a new phone. You know how to use the phone, but you don't know all the features that can improve your life. Employees don't understand what are the tax withholding rates and why. The employer normally withhold 22% on the vesting value on the vesting date, plus Medicare of 1.45% and Social Security of 6.2% if applicable. That is a total of 29.65%, and it does not include state and local tax. Normally, there is a statutory withholding rate of 22% for supplemental income under $1 million and 37% withholding rate for supplemental income excess of $1 million. You have to know what is your total taxable income, because if you make $400,000 at your company and $800,000 come from your rental property income and investment, the 22% withholding your companies withhold is not enough to cover the taxes. Thus, you have to make the estimated tax to your state and federal government. The company did not withhold enough taxes when the restricted stock units and or restricted stocks vest, and you did not put aside money to pay for the difference when you do your tax return. Thus, you have to sell the employer stock when you don't want to. For example, the company withholds 22% while you're in a 37% tax bracket. In this case, you want to set cash aside or log into your state websites and the federal website to pay the estimated tax. Not withholding enough tax, and employees keep doing it annually. There could be a penalty for underpayment. Employer thought they could make a 83B election on restricted stock units. Keep the employer stock after it vests and sell it in a year. The gain is short-term capital gain, and it is taxed at ordinary income tax rate. Directly from the IRS website. Restricted stock units are unsecured, unfunded promises to pay cash or stock in the future and are considered non-qualified deferred compensation. Which means your employer promises you X number of restricted stocks units that will vest in the future. That is just a promise, and there is nothing backing it up except for the employer good faith. Employees change jobs before restricted stock units and or restricted stock vest. Thus, the shares are not vested and the employees will not get anything from the unvested shares. Employee commingling the rules of restricted stock unit, restricted stocks, and other stock option plans. The big difference between restricted stock units, restricted stocks, and stock option is you need to pay to exercise the stock options and restricted stock unit, and normally restricted stocks are given to you and you don't exercise them. Not confirming the numbers to make sure the tax reporting is correct. You must understand how you are being taxed on your restricted stock unit and or restricted stock. Make sure your supplemental income on Form W-2 is properly reflecting the fair market value at vesting and the amount withheld by your employer. Having a concentrated stock position and not being aware of the risk. Not only are you taking on the unsystematic risk from the employer stock, If your company goes out of business or terminates you, you will lose your job and your wealth in the employer stock. Problems with restricted stock units and restricted stocks employees are confused about. How am I going to pay for the tax withholding? What to do with the employer stocks once the stock is deposited in my account? What to do with the cash when I sell the employer stock? How are restricted stock units and restricted stock taxed? You do not have a tax liability when restricted stock units and restricted stocks are granted to you, unless you make an 83B elections on the restricted stock. You have a tax liability when the shares are vested based on the fair market value of the employer stock price times the number of shares. It is taxed at ordinary income tax rates. You have another tax liability when you sell the employer stock if there is a gain. The change after the vesting date is considered capital gain or loss, short-term or long-term depending on the holding period. If you sell the stock at a higher price than the value at vesting, you have a capital gain. If you sell the stock at a lower price than the value at vesting, you have a capital loss. If you sell the stock after a year, 1 year plus 1 day, that is considered long-term. If you sell the stock within a year, that is considered short-term. The most favorable tax treatment is long-term capital gains. If you have a capital loss, losses on your investments are first used to offset capital gains of the same type. Some short-term losses are first deducted against short-term gains, and long-term losses are deducted against long-term gains. Net losses of neither type can then be deducted against the other kind of gain. So for example, if you have $2,000 of short-term loss and only $1,000 of short-term gain, the net $1,000 short-term loss can be deducted against your net long-term gain, assuming you have one. If you have an overall net capital loss for the year, you can deduct up to $3,000 of that loss against your other income, including your salary and interest income, for example. Any excess net capital loss can be carried over to subsequent years to be deducted against capital gains and against up to $3,000 of other kind of income. If you use separate filing status, however, the annual net capital loss deductions limit is only $1,500. You should get a 1099-B from your broker. Taxation summary for My Stock Option. FICA taxes, including the 1.5% Medicare tax plus the 0.9% additional Medicare tax for a certain high-income taxpayer, is due at the vesting date. These arrangements allowing the deferral of the date when awarded or taxed must comply with the deferred compensation rules of IRC Section 409A. The Federal Insurance Contribution Act, FICA, is a federal law that requires withholding of 3 separate taxes from the wages: 6.2% Social Security tax, 1.45% Medicare tax, the regular Medicare tax, and 0.9% Medicare surtax for high-income earners. Taxation summary from Charles Schwab. With restricted stock unit and restricted stock, you are taxed when the shares are delivered, which is almost always at vesting. Your taxable income is the market value of the shares at vesting. You have compensation income subject to federal and employment tax, Social Security and Medicare, and any state and local tax. That income is subject to mandatory supplemental wage withholding. Withholding taxes which for U.S. employees appear on Form W-2 along with the income includes the following: federal income tax at the flat supplemental wage rate, unless your company uses your W-4 rates, Social Security up to the yearly maximum, and Medicare, state, and local taxes when applicable. Restricted stock unit summary. At grant equal no tax. At vesting equal taxable at ordinary income tax rates. At sale equal short-term or long-term and gain or loss depending on the holding period and sale price. Strategies to consider with restricted stock units and restricted stock. Sell the share once they are vested, then use the money to build a diversified investment portfolio Pay debt, fund a goal because restricted stock unit and restricted stocks are taxed as soon as they are vested. Keep the employer stocks and use option contract to mitigate the risk. Keep the employer stocks and build a portfolio around the employer stock. Keep the employer stock, be in a concentrated stock position, then sell it when it is advantageous to sell the employer stock. If you want to hold the employer stock, you should understand the risk of investing in individual stocks. I made a video on the risk of investing in individual stocks, and you can check it out at www.10fan.com/blog. Exchange fund. If you currently have a lot of employer stocks and you don't want to sell it because it will trigger a taxable event, you can look into doing an exchange fund where you exchange your employer stock for a diversified portfolio. The more money you have in stock options, such as restricted stock units, restricted stocks, ESPP, ISO, the more strategies are available to you because there are costs associated with the strategies. Take advantage of the volatility in the stock price. If you can sell certain shares at a loss, it is advantageous to sell the shares and realize the loss. Why? Lower your tax burden. Diversifying away from a concentrated stock position. Converting stocks into cash. Capital losses offset capital gain, then up to $3,000 from capital losses can offset earning income, then remaining losses can carry forward into the future. If you really like your employer stock, you can buy it back later. But be careful of the watch sale rules. If you have restricted stocks units and or restricted stocks that vested and are going to vest, you should have a plan. You should always know how your employer stock or dollar value will work with your portfolio and overall financial plan. Without a plan, you could be paying a lot more in taxes and be exposed to the risks that are associated with a concentrated stock position. Feel free to ask us questions so we can answer it in future videos. They are likely to be helpful to other employees as well. This video intended for educational purposes only and tax law changes. You should talk to a professional before making an informed decision. Thank you for watching. This is Tan, your trust advisor.